Imagine having the ability to identify two companies, not just any companies, but those on the verge of explosive growth, poised to potentially deliver substantial returns to your investment portfolio. Before Wall Street catches on, and the broader market recognizes their true potential, today, we're diving deep into the analysis of a beverage disruptor, a company generating cult-like momentum, and a streaming giant that is fundamentally reshaping the landscape of how we consume TV and entertainment. These aren't just random picks based on speculation. They're carefully selected, backed by real numbers derived from rigorous financial analysis, strong fundamentals indicating long-term viability, and game-changing catalysts that could propel them to new heights. We'll meticulously break down the key factors that suggest why these stocks have the potential to skyrocket, and what precisely makes them stand out as potential standout performers in today's dynamic and competitive market. If you're seeking actionable insights and strategic perspectives that could potentially transform your investment portfolio, stick around and stay tuned. Don't forget to smash that like button, share your valuable thoughts and perspectives in the comments section below, and subscribe to our channel for more regular investing updates and insightful analysis. Let's jump right in and get started. First up, Celsius Holdings, ticker CELH. We're diving into a company that's not just making waves, but creating a tsunami in the beverage industry. Keep your eyes peeled as we unpack the Celsius phenomenon. If you've been to a gym, convenience store, or grocery store lately, you've seen their brightly colored cans everywhere. They're hard to miss, strategically placed to catch your eye. Celsius has gone from a relatively niche fitness drink, known primarily in health circles, to a mainstream powerhouse, challenging the established giants of the energy drink world. It's a remarkable transformation. This meteoric rise is thanks in no small part to its clever Live Fit branding, which resonates with health-conscious consumers, and its carefully selected health-focused ingredients. They've tapped into a powerful trend. Millennials and Gen Z, increasingly aware of the health implications of their choices, are ditching sugary, artificially flavored energy drinks in droves. They're looking for healthier alternatives, and that's where Celsius steps in, offering a clean, functional boost without the guilt. It's the perfect pick-me-up for the modern, health-conscious individual. The numbers speak for themselves. We're talking about triple-digit revenue growth quarter after quarter, a testament to the brand's increasing popularity and effective strategies. They're not just growing incrementally, they're aggressively taking market share, carving out a larger piece of the pie with each passing quarter. This is a sign of a truly disruptive force. And where is that market share coming from? Primarily from established players like Monster and Red Bull, who are now facing a serious challenge to their dominance. But perhaps the real game changer, the catalyst that propelled Celsius to new heights, was their strategic distribution deal with PepsiCo. This partnership was a masterstroke. Almost overnight, Celsius gained access to Pepsi's unparalleled global distribution network, a network that spans continents and reaches countless retail outlets. This meant putting their drinks on shelves everywhere, from major supermarkets to local convenience stores, significantly increasing their visibility and accessibility to consumers. But Pepsi didn't just agree to distribute their products, they also invested a substantial sum in Celsius, demonstrating their belief in the company's long-term potential. This investment signaled huge confidence in Celsius's future prospects, sending a clear message to the market that PepsiCo sees something special in this brand. And Celsius isn't resting on its laurels. With a constant stream of new flavors and a commitment to continuous innovation, they're keeping their product line fresh and exciting. This dedication to innovation helps Celsius keep its brand fresh, relevant, and its ever-growing base of fans incredibly loyal. They've created a strong sense of community around their products. It's important to remember that the global energy drink market is absolutely massive, and it's still expanding at a rapid pace, presenting a huge opportunity for Celsius. And Celsius's focus on a healthy angle, with its emphasis on natural ingredients and functional benefits, positions it perfectly to capitalize on this growing trend. From a financial perspective, they're making significant strides toward profitability and generating positive cash flow, which are key indicators of a healthy and sustainable business. This demonstrates that their impressive growth isn't just a flash in the pan, but rather a sign of a sustainable business model built for long-term success. And let's not forget about their marketing strategy, which can only be described as genius. They've truly mastered the art of connecting with their target audience. Their effective use of social media influencers and brand ambassadors has been instrumental in building brand awareness and driving sales. They've tapped into the power of social media marketing. This has helped them build a vibrant grassroots community of loyal customers who actively advocate for the brand, spreading the word and attracting new consumers. When compared to legacy brands in the beverage industry, Celsius is remarkably nimble, innovative, and quick to adapt to changing consumer preferences. They have a deep understanding of today's consumers, particularly millennials and Gen Z, and they're constantly evolving their products and marketing strategies to stay relevant. Now, it's true that the stock can be volatile, experiencing periods of significant price fluctuation, which is not uncommon for high-growth companies. However, if you zoom out and look at the long-term trend, it's clear that the overall trajectory is upward, reflecting the company's strong performance and future potential. And the exciting part is that their international expansion is really just beginning. They've only scratched the surface of the global market opportunity. Currently, the vast majority of their sales are concentrated in North America, but with the power of Pepsi's distribution network behind them, global growth is undoubtedly the next major chapter in the Celsius story. The potential for expansion is enormous. Celsius fans aren't just customers, they're fanatics. They actively post about the brand on social media, enthusiastically recommend it to their friends, and create a powerful network effect that drives new sales and amplifies brand awareness through word-of-mouth marketing. This level of brand equity, this deep connection with consumers, is something that most companies can only dream of achieving. It's a valuable asset. And to top it all off, Celsius is consistently beating analyst expectations, exceeding projected revenue and earnings targets. This consistent outperformance is a clear indication of management's strong execution and their ability to deliver on their promises. They're not just another energy drink company churning out the same old formulas. They're blurring the lines between the energy drink category, the sports nutrition market, and the broader wellness industry, appealing to a wider range of consumers. This strategic positioning is allowing them to continuously broaden their customer base and attract new demographics who are seeking healthier and more functional beverage options. By strategically targeting college campuses and fitness centers, they're reaching key demographics and building brand awareness among influential groups. This targeted approach is helping them cultivate customer loyalty and build long-term relationships with consumers who are likely to remain fans of the brand for years to come. Ultimately, they're building a solid foundation for decades of sustained growth based on a sustainable business model and a deep understanding of their target market. It's true that the stock isn't cheap, and it trades at a premium valuation, but that's fairly typical for hypergrowth companies that are disrupting established industries. With a market cap of $10.01 billion and annual revenue reaching $1.36 billion in 2024, the company's growth trajectory is nothing short of impressive. Despite operating in a highly competitive space, Celsius has carved out a niche, fueled by strong branding and increasing consumer demand for healthier energy alternatives. Its net income for the year came in at $145.07 million, with earnings per share at 34 cents. That valuation does come at a premium though. The PE ratio stands at 125.15, suggesting that investors are betting heavily on continued growth. This kind of multiple reflects strong future expectations, especially as the company expands its retail footprint and increases distribution partnerships across global markets. With fitness culture and wellness trends showing no signs of slowing down, Celsius is positioning itself as a frontrunner in the next generation of performance beverages. When you invest in Celsius, you're not just buying their present performance, you're investing in their future growth potential and their ability to continue disrupting the beverage industry. In contrast, Monster and Red Bull, while still dominant players, have been relatively slow to innovate and adapt to changing consumer preferences. This makes Celsius the agile speedboat, quickly outmaneuvering the much larger and slower giants in the energy drink market, gaining a significant competitive advantage. And at the helm of this innovative company is CEO John Fieldly and his dedicated team, who have skillfully steered the company with both vision and expertise, navigating the challenges of a rapidly evolving market. Of course, there are always risks to consider. Growth could potentially slow down, or a new innovative competitor could emerge and challenge Celsius's dominance. However, Celsius's strong brand recognition, its extensive distribution network, and its incredibly loyal fanbase provide a significant buffer against these potential risks. These factors combine to create a strong competitive moat, protecting the company from competitive pressures and ensuring its long-term viability. There's even the potential for a full acquisition down the line, perhaps by PepsiCo, which already has a significant stake in the company. Such an acquisition would likely come at a premium, rewarding investors who recognize the company's value early on. Furthermore, their sophisticated use of data analytics allows them to understand exactly which flavors and products are resonating with consumers, enabling them to optimize their product offerings and maximize their return on investment. So, despite the impressive run-up in the stock price, the Celsius story is far from over. There are still plenty of chapters left to be written. The opportunities for international expansion and the development of new product categories are vast and largely untapped. These initiatives are really just getting started, and they represent a significant growth runway for the company in the years ahead. To recap our analysis, Celsius is more than just an energy drink. It's a category-defining brand that has achieved explosive growth, forged a powerful partnership with PepsiCo, and cultivated a passionate cult-like following among its customers. For growth-oriented investors, Celsius presents a compelling investment opportunity with significant runway left for future expansion and value creation. It's a story worth watching closely. Alright, let's dive into another exciting player in the tech world, Roku, ticker Roku. We're going to break down their business model, explore their strengths, and discuss the potential risks and rewards for investors. So, buckle up as we navigate the world of streaming with Roku. In the ever-expanding streaming universe, Roku has carved out a unique and powerful position. It's the platform that unites all your favorite services under one digital roof. Think of it as the ultimate aggregator, bringing together a vast library of content for your viewing pleasure. Netflix, the streaming giant that needs no introduction. Disney+, home to beloved characters and blockbuster franchises. Hulu, with its diverse range of shows and movies, and countless others. Roku brings them all together, offering a centralized hub for your entertainment needs. It's a one-stop shop for streaming content. What's truly ingenious about Roku's strategy is that it doesn't compete directly with these content giants. Instead, Roku profits from all of them, regardless of which service you choose to watch. This is a key differentiator that sets them apart. Roku is acting as the Switzerland of streaming, a neutral platform that welcomes all players. This unbiased approach is crucial to their success. While they do sell streaming devices, the real money, the true engine of their growth, isn't in selling those devices, it's in their high-margin platform segment. This is where the magic happens, primarily through ad revenue as brands flock to the platform to reach Roku's massive audience, but also through subscription cuts, taking a percentage of subscription fees from services offered on their platform, and of course through the Roku channel, their own ad-supported streaming service. Roku boasts tens of millions of active accounts, and the number of hours streamed on the platform continues to climb steadily. This engagement is a key indicator of their strength. All of this translates to more ad dollars flowing into Roku's coffers, fueling further growth and expansion. The Roku channel is arguably their secret weapon in this streaming war. By offering free, ad-supported content, they're not only attracting more users, but also capturing a bigger slice of the lucrative ad pie. It's a brilliant strategy. As more and more people cut the cord and ditch traditional cable, TV ad budgets are inevitably shifting to streaming platforms. And Roku is perfectly positioned to catch those ad dollars, acting as a primary beneficiary of this massive shift in advertising spend. Roku OS has become the top-selling smart TV operating system in North America, a testament to its popularity and user-friendliness. Roku's operating system is built into millions of TVs from popular brands like TCL, expanding their reach and solidifying their market position, and Hisense, further demonstrating the trust and value that TV manufacturers place in the Roku platform. Their neutrality is a key advantage that resonates with consumers. Roku's interface is clean, simple, intuitive, and focused on providing users with a wide range of choices. They're not pushing their own content aggressively, creating a level playing field for all streaming services. The ongoing shift to connected TV advertising is not just a trend, it's a full-blown revolution, representing a multi-billion-dollar opportunity. And Roku, with its dominant position and innovative platform, is the purest play on this transformative shift in the advertising landscape. Roku's access to first-party viewing data is like gold for advertisers, providing invaluable insights into viewer behavior and preferences. This data allows for precise targeting of ads, leading to higher engagement and ultimately, premium ad rates for Roku. While Roku has a strong foothold in North America, their international expansion is really just beginning, presenting a significant growth opportunity. They've already made inroads into markets like the UK, demonstrating their ability to adapt and succeed in new territories. Germany represents another key market for expansion, with its large population and growing adoption of streaming services. And Brazil, with its massive population and increasing internet penetration, is another promising market on the horizon. It's important to acknowledge that the stock has been volatile, facing headwinds from ad slowdowns and increased competition in the streaming space. However, the fundamental long-term trend towards streaming remains firmly intact, providing a strong foundation for Roku's future growth. For savvy investors, this recent pullback in the stock price could represent a compelling buying opportunity to acquire shares at a discounted valuation. The market may be currently overlooking Roku's dominant position in the streaming ecosystem and its significant monetization potential. The network effect is a powerful force working in Roku's favor. As the platform attracts more users, it becomes more attractive to content providers and advertisers. This creates a virtuous cycle, where more content and advertising attract even more users, fueling further growth and expansion. At the helm of Roku is founder and CEO Anthony Wood, a true visionary in the world of streaming technology. He brings decades of invaluable experience to the table, having played a pivotal role in shaping the evolution of TV technology. Roku is not content with just streaming. They're actively innovating beyond, exploring opportunities in smart home devices and voice control technology. This strategic move positions Roku to become a central hub within the increasingly connected home ecosystem. The beauty of the platform model lies in its inherent scalability. As revenue grows, margins expand, and profitability has the potential to accelerate significantly. Of course, it's crucial to acknowledge that Roku faces stiff competition from tech giants like Amazon and Google in the streaming device market. However, Roku's singular and unwavering focus on the TV experience gives them a distinct competitive edge. Their strong financial balance sheet provides them with the flexibility to continue investing in growth initiatives and pursue strategic acquisitions. Roku's ARPU, or average revenue per user, continues to rise, demonstrating their ability to effectively monetize their user base, even in challenging economic times. With a market cap of $11.68 billion and $4.11 billion in revenue for 2024, the platform continues to capture a significant share of the connected TV space. But unlike Celsius, Roku is still struggling to translate its top-line growth into profitability. The company reported a net loss of $129.39 million this year, as it continues to invest heavily in content, platform enhancements, and international expansion. Despite the red ink, Roku's long-term outlook hinges on the evolution of ad-supported streaming. As more consumers move away from traditional cable and toward digital platforms, Roku's role as a content aggregator and ad tech provider becomes increasingly important. While the road to profitability may be rocky in the short term, the company remains a key player in the shift toward a streaming-first media landscape. When you invest in Roku, you're not just buying a piece of a hardware company. You're buying a piece of the entire streaming ecosystem. You're investing in a platform that connects content providers, advertisers, and millions of viewers. What are the potential risks? A prolonged period of weakness in the ad market or increasingly aggressive competition from deep-pocketed rivals. However, Roku's established market leadership position and the powerful secular tailwinds driving the growth of streaming make it a risk that may be worth taking for long-term investors. TV manufacturers genuinely appreciate Roku OS because it's a win-win partnership that helps them sell more TVs while solidifying Roku's position as an industry standard. With the introduction of Roku Originals and other exclusive content, they're giving users even more compelling reasons to stay engaged and spend more time on the platform. This increased engagement directly translates into higher advertising revenue for Roku. The path to achieving long-term profitability is clearly visible. As their high-margin platform revenue continues to grow, overall profits are poised to inflect upward significantly. To sum it all up, Roku has established itself as the dominant TV operating system, boasting a highly scalable platform, benefiting from massive streaming tailwinds and guided by a visionary leader. So while there may be short-term fluctuations and market noise, the long-term investment thesis for Roku remains compelling. This could be a golden opportunity to acquire a market leader with tremendous upside potential. There you have it. Celsius and Roku, two leaders riding unstoppable trends with massive growth potential. The key? Look past the headlines and focus on the fundamentals and long-term vision. These are the kinds of opportunities that can truly build wealth over time. If you're ready to take your investing to the next level, start your research now. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments, no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Question for you: which stock do you think has the most explosive growth potential in the next year? Celsius, Roku, or another company? Let me know your pick and why in the comments below. Don't forget to like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important financial investing update. Thanks for watching, and I'll see you in the next one.